Hello, this is Japanese Economic Review Channel. Welcome to the executive briefing on Japan department store sales for February 2026. Today, we will explore shifting consumer behaviors, geographic polarization, and macro trends. Despite inbound challenges, total sales reached 432 billion yen, a 1.6% YoY increase. Let's dive into the key drivers. Total sales grew by 1.6%, supported by a resilient domestic market which accounts for 89.5% of our share. Domestic sales achieved a seventh consecutive month of growth at 4.0%. This robust performance successfully offset a sharp 15.5% decline in inbound tax-free sales caused by a drop in Chinese tourism. 12-month trajectory reveals a stabilizing domestic base. While inbound volatility has disrupted macro averages, domestic baseline spending remains firmly positive since August 2025. Conversely, regions outside the top 10 cities continue to struggle, marking 4 consecutive months of decline. 4 distinct drivers fueled our domestic engine. Early spring warmth boosted apparel, while the graduation season spiked occasion wear demand. Creative Valentine's events drove foot traffic, raising confectionery sales by 6.3%. Finally, gaisho events secured high-ticket luxury sales despite economic caution. Regarding inbound sales, regional travel restrictions created a severe squeeze. The absence of Chinese tourists led to a 40% drop in sales volume. Although we saw positive growth from South Korea due to the Lunar New Year, these emerging Asian offsets were eclipsed by the massive China deficit. Geographically, we observe a stark divide. The 10 major cities, insulated by corporate demand and luxury gaisho events, posted a 2.2% sales increase. Conversely, the 7 regional districts lack this luxury buffer and remain highly vulnerable, contracting by 0.9% for the 4th consecutive month. City-level baselines are highly distorted by micro-events. Nagoya was a massive outlier, surging 14.8% due to localized store closing sales. Tokyo maintained a steady 3.0% growth, anchored by high-net-worth clients. However, Osaka contracted by 3.5%, heavily exposed to the inbound crash. Our category spectrum exposes extreme consumer polarization. We see a K-shaped trend. Consumers aggressively fund high-ticket luxury and experiential moments while cutting back on household durables. Services surged by 25.5%, whereas furniture and appliances plummeted by 17.1% and 10.8% respectively. The wealth effect drove an 18.0% surge in high-end assets like art and jewelry. High domestic stock valuations created strong wealth among affluent consumers. This was amplified by a post-pandemic bridal recovery and focused gaisho exhibitions, capturing high-net-worth spending. Conversely, cosmetics faced dual pressures, contracting by 10.0%. First, we suffer from a reactionary drop following last year's artificial surge before industry-wide price hikes. Second, cosmetics absorbed the brunt of the inbound evaporation from the drop in Chinese tourist traffic. Experiential retail strategies amplified the Valentine's halo, jumping confectionery sales by 6.3%. We achieved this through spatial innovation, like Eden Spaces. Scarcity marketing with limited items and seamless omnichannel integration connecting physical events with e-commerce drove footfall. Remarkably, operational efficiency yielded higher output despite a shrinking footprint. While headcount dropped 3.1% and floor space 1.4%, we drove top-line growth. This structural reduction in overhead boosted sales per employee by 4.8% and sales per 100 square meters by 3.0%. To synthesize our strategy, first, cultivating our gaisho safety net with affluent domestic clients is imperative to protect margins. Second, diversifying inbound marketing toward broader Asia is required to mitigate risks. Finally, we must realign floor space to cater to the entrenched K-shaped economy. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.